8 Investing mistakes to avoid in 2023. We all want our investments to flourish, right? But let's face it, the path to financial success is riddled with obstacles. But don't be afraid. By understanding these common mistakes and learning how to sidestep them, you'll be well on your way to achieving your financial goals and securing a prosperous future. Whether you're a seasoned investor or just starting out, this video is packed with valuable insights that will help you avoid the pitfalls that many fall into. Trust me, by the end of this video, you'll be equipped with the knowledge to make better informed decisions and maximize your returns. The first mistake to avoid is ignoring the power of compounding. Compounding is a powerful force that allows your investments to grow exponentially over time. By reinvesting your earnings, dividends, and interest, you can benefit from the compounding effect. The earlier you start investing, the longer your investments have to compound and generate significant returns. Let's illustrate the power of compounding with an example. Suppose you invest $10,000 in an investment vehicle that generates an average annual return of 8%. If you leave that money invested for 20 years, without adding any additional funds, your initial investment would grow to approximately $46,610. That's more than 4 times your initial investment. The second mistake to avoid is neglecting proper research. Many investors fall into the trap of chasing trends or following the crowd without conducting thorough research. While it's tempting to jump into the latest hot stock or investment opportunity, it's essential to remember that investing is not a game of luck. It requires careful analysis of market trends, company fundamentals, and economic indicators. Make sure to gather as much information as possible about the investment opportunities you're considering. This will help you make informed decisions and reduce the risk of investing in something you don't fully understand. Research involves studying a company's financial statements, understanding its competitive landscape, and evaluating its growth prospects. Additionally, keeping track of broader market trends, industry developments. Mistake number 3 is trying to time the market. It's a common misconception that by buying at the lowest point and selling at the highest, you can maximize your returns. However, successfully timing the market consistently is extremely difficult, even for seasoned professionals. Instead of trying to predict short-term fluctuations, focus on long-term investing strategies. A better approach is to invest in quality companies or diversified funds that align with your financial goals and risk tolerance. By adopting a long-term perspective, you can ride out market volatility and potentially achieve more stable returns over time. Remember, investing is not a sprint, it's a marathon. Another critical mistake is failing to diversify your portfolio. Investing all your money in a single stock or asset class exposes you to significant risk. If that investment performs poorly, your entire portfolio could suffer. To mitigate this risk, diversify your investments across different sectors, asset classes, and geographies. By spreading your investments, you reduce the impact of any one investment's performance on your overall portfolio. Diversification helps protect your portfolio from the adverse effects of market volatility and unforeseen events. It allows you to participate in the potential growth of various industries and regions, while also cushioning the impact of underperforming investments. Mistake number 5 is making investment decisions based on emotions. Fear and greed often lead investors astray, causing them to buy high and sell low. It's crucial to separate emotions from your investment decisions and stick to a well-thought-out plan. Avoid making impulsive moves based on short-term market fluctuations or sensational news headlines. To overcome emotional decision-making, it's important to establish clear investment goals and create a disciplined investment strategy. Set realistic expectations and maintain a long-term perspective. By focusing on your financial objectives and staying disciplined, you can resist the temptation to make emotionally driven investment decisions. Okay, next talk about how to avoid the mistake of chasing fads and hot tips. It's easy to get excited when we hear about a trendy stock or a hot investment opportunity. But trust me, it's important to stay level-headed and make smart decisions. Here's what you can do. Do your homework. Before investing in anything, take the time to do some research. Look into the company's financial health, its competition, and its potential for long-term growth. This will help you understand if the investment is based on solid foundations or just a short-lived trend. Another mistake is overpaying for investments. Let's look at how you can avoid this. High fees and expenses can eat into your investment returns, and we want to keep as much of our money as possible. Here are a few tips to help you out. Compare fees and costs. Different investments come with different fees and costs. It's essential to compare these fees before making a decision. Look for investments with lower fees, as they allow you to keep more of your money. Compare things like management fees, expense ratios, and transaction costs to find the best option for you. Opt for low-cost options. When it comes to mutual funds or exchange-traded funds, keep an eye on the expense ratio. This ratio represents the percentage of your investment that goes toward fees. Lower expense ratios mean you're paying less for the fund's management, which can lead to higher returns over time. Another mistake is not having an emergency fund. Investing without an adequate emergency fund can leave you vulnerable to unexpected expenses or financial emergencies. To avoid this mistake, prioritize building an emergency fund as a safety net. Here's how. Set aside savings. Allocate a portion of your savings specifically for the emergency fund. Aim for 3 to 6 months' worth of living expenses, adjusted according to your situation. Choose a liquid account. Keep the emergency fund in an easily accessible and liquid account, such as a regular savings or money market account. Be consistent. Make regular contributions to your emergency fund by setting up automatic transfers from your income. Treat it as a non-negotiable expense. Preserve its purpose. Resist the temptation to use the emergency fund for non-emergency purposes. Maintain a clear distinction between your emergency fund and other savings or investment accounts. Remember, emergencies can arise unexpectedly, and having an emergency fund provides financial stability. By building this cushion, you can handle unforeseen circumstances without derailing your long-term investment goals. Secure your financial future by prioritizing and actively saving for emergencies. Investing wisely is a journey that requires knowledge, patience, and discipline. By avoiding these 5 common investing mistakes, neglecting proper research, timing the market, lack of diversification, emotional decision-making, and ignoring the power of compounding, you can set yourself up for long-term success. Remember, investing is about making informed decisions, staying focused on your goals, and having a long-term perspective. Take the time to thoroughly research your investments, understand the risks involved, and align them with your financial objectives. Avoid trying to time the market, as it's nearly impossible to consistently predict short-term fluctuations. Furthermore, diversify your portfolio across different sectors, asset classes, and geographies to mitigate risk. This will ensure that your investments are not overly exposed to the performance of a single investment or industry. Emotionally driven decisions can lead to costly mistakes, so stay disciplined and stick to your investment strategy. Lastly, harness the power of compounding by reinvesting your earnings and taking advantage of the growth potential over time. Remember that investing is a long-term commitment, and it's important to stay invested and allow your investments to compound over the years. As you continue your investing journey, always seek to expand your knowledge, stay updated with market trends, and learn from experienced investors. By avoiding these common investing mistakes and adopting a disciplined approach, you can improve your chances of achieving your financial goals and building long-term wealth. Happy investing!